How's it going, guys? This is Forensic Forex with Deontay, and I'm back with another video. This is episode 20 to the Asian Session Library. On Wednesday the 3rd, January 2024, we had a successful Asian Session model with the pair US dollar versus Japanese yen. Let's walk through it together. We are utilizing the 15-minute swing highs and swing lows as the available liquidity we have going into the Asian Session model. We do not like to trade between 12 p.m. to 8 p.m. and these times are in New York Eastern Standard Time. The reason we don't trade within this time period or the late PM sessions of the day is because most likely you're going to run into a phase of accumulation or consolidation. The market's going to trade back and forth. Going into the Asian session, we're going to be utilizing the buy side and sell side liquidity we have available. So let's take a look at what happens. So price comes up and takes out that 15-minute swing high. And what's above this 15-minute swing high? Buy side liquidity. So at this point, we're going to look for an opportunity to potentially go short towards the sell side liquidity. So we got a purge on buy side liquidity. We're looking for a revert back down to sell side liquidity. Now, that doesn't mean price has to get down here, but we're looking for a trade idea where we're going short after what? Breaking a high and a 15-minute swing high where there's buy side above. And we're going short where? In a premium. So these things are aligning for me to find a better odd scenario for my sell position. So let's scale down to the 1 minute. Now, my entry technique is generally always on the 1 minute. You can look for something on a 2, 3, or 5, but the entry technique that I'm looking for is a swing low that's going to be broken with a fair value gap and a premium. So this entry technique has to form above 8 p.m. opening price. Let's play it out to see where it forms. So we can see here, we have price breaking a swing low. 1, 2, 3. That's a swing low. We even have one over here. 1, 2, 3. So it makes equal lows here or double bottoms. And there's a fair value gap going through those swing lows. So we got it here from this candle's low to this candle's high. That's our fair value gap. Notice where it's forming above the Asian session open. That black dotted line there is Asian open. We're in a premium. So we don't need indicators to tell us if the market is overbought or oversold. We know we're in an overbought condition because we're simply above fair value, 8 p.m. opening price. We have those swing lows here. So let's mark off the first one. We have one that right there. We also have the other one there. So speed is going through that swing low. This is where we're going to look to go short. It's just like all the other episodes prior to this. It's the same exact thing. I'm going to be looking for a 1-to-1 scenario. And I like to look for a 15 pip stop loss. If we could get it on 15. There we go. And then a 15 pip TP. So that's a 1-to-1, a dollar for a dollar. Now, you could be risking 1%. You could be risking 2%. I wouldn't go beyond 2%, of course. Or you could be risking 0.5%. It all depends on what your equity and risk appetite is. And definitely follow your risk management. If you lost a trade already and you're down 2% in the account, you shouldn't be risking another 2%. You should be risking 0.5% to gain back some mitigation on what you have lost. So price trades into that fair value gap. And we can see we play it out. We're in some drawdown. But with experience, of course, you will stick to your trade. Sometimes intuition will tell you to probably get out your trade, but most times you would believe into your model and not abandon ship unless something tells you otherwise. Price comes down and gets us just 15 pips. So if you measure this from the entry down to here, we got 14.6 pips before price turns around for the rest of the session and go all the way to 8 p.m. right there. So price stops us out. So we didn't get the 15 pips that we would want had expected. However, we got the 10 pips. So minimalistically, I told people all the time, if you're going to take partials for the trade, you take 10 pips off, move stop loss to break even or inside profit to make it risk-free and move on. At times, greed can be your worst enemy when it comes to trading. As you gain experience trading, you got to understand when to pay the trader, when to move your stop loss, and when to tell yourself enough is enough. We can see that price comes down and gets just to 15 pips. We don't get it, but we were able to at least get 10 pips out of this market and a little more just before 15. So hopefully this is insightful. Once again, the model stands true. It is a very simplistic approach. Here is Wednesday. So like I said before, Tuesdays and Thursdays, I tend to see the market trend. When you find the model, trend into the next day. Here on Wednesday, it's actual agent session. We can see it was technically unsuccessful for giving us 15 pips, but it was successful in general in giving us the 10. Peace.